Welcome once again to One SME Talks. Our topic session is focused on 10 techniques how to evaluate startup profit growth. Let's check the list. Number one, track net income over time. Net income is the amount of money left over after all expenses have been paid. It is the most basic measure of profitability. Number two, calculate profit margins. Profit margin shows how profit is generated from each unit of revenue. Gross profit margin measures the percentage of revenue that remains after direct cost of goods sold have been subtracted. Operating profit margin measures the percentage of revenue that remains after all operating expenses, including direct cost of goods sold and selling, general and administrative expenses have been subtracted. Net profit margin measures the percentage of revenue that remains after all expenses, including taxes, have been subtracted. Number three, analyze revenue growth. Revenue growth is the rate at which revenue is increasing over time. It is a key indicator of a startup's health and growth potential. Number four, look at customer acquisition cost. Customer acquisition cost is the average cost of acquiring a new customer. It is important to track customer acquisition cost to ensure that it is lower than the lifetime value of a customer. Number five, monitor customer churn rate. Customer churn rate is the percentage of customers who stop using a product or service over a period of time. It is important to keep up with the customer churn rate low to maintain profitability. Number six, evaluate customer lifetime value. Customer lifetime value is the average of amount of revenue that a customer is expected to generate over the course of their relationship with the customer. It is important to track customer lifetime value to ensure that it is greater than customer acquisition cost. Number seven, track unit economics. Unit economics measures the profitability of each unit of revenue. It is important to track unit economics to ensure that the startup is generating a profit on each sale. Number eight, analyze cash flow. Cash flow is the movement of money into and out of a business. It is important to track cash flow to ensure that the startup has enough money to operate and grow. Number nine, compare financial performance to peers. Comparing financial performance to peers can help to identify areas where the startup is excelling or failing behind. Last, which is number 10, use discounted cash flow analysis. A discounted count analysis is a valuation method that takes into account the future of cash flow of a business. It can be used to estimate value of a startup and track its profit growth over time. Thank you very much for tuning in, and please subscribe to our channel.